Hi, welcome to today's webinar. I am Jessica Larson. I'm an attorney with Beardsley, Jensen, and Lee, and I'm a member of the State Bar CLE Committee, and I'll be chairing the CLE today. Before we get started, I just want to go over a few things so you know how to participate in today's event. And first, I want to start with a message about Lawyers Concerned for Lawyers. If you or another State Bar member or law student you know have a drug or alcohol problem or struggle with depression or anxiety, Lawyers Concerned for Lawyers is a confidential and independent resource for South Dakota lawyers, law students, and their families. Your referral or visit with the Lawyers Concerned for Lawyers is strictly confidential and privileged. Call Becky Porter for more information at 605-391-5191. Becky is a LCL member, and your communications are likewise confidential and privileged. You can also call 988 to reach a mental health professional or the Sand Creek Employee Assistance Program at their confidential crisis telephone line at 188-243-5744. Mental health professionals at both numbers are available 24 hours a day, 7 days a week. Some information on the contact information is placed in the chat, and you can see that now. Today's presentation will last approximately 1 hour. You'll have the opportunity to submit text questions to today's presenters by typing your questions into the chat feature of the Zoom. You may send in your questions at any time during the presentation, and we will collect and address them during the Q&A session at the end of today's presentation. Thank you to the State Bar of South Dakota and CLE Inc. for their support of today's program. And I'd now like to introduce our presenters. Melanie Jobjan is a certified public accountant and income partner with Casey Peterson. This Phillips, South Dakota native earned her bachelor's degree in professional accountancy from Black Hills State University. And Melanie has worked for 2 years in private accounting prior to joining Casey Peterson in 2007. Lori Larson is also an income partner with Casey Peterson, and she has nearly 2 decades of experience working in public accounting, performing tax and accounting services. She's been a CPA since 2005 and attended Black Hills State University, where she earned her Bachelor of Science degree in accounting. And with that, I will turn it over to the presenters for today's presentation.
Thank you, Jessica, for that introduction. We feel privileged to be able to speak with you today. We have a few topics that we'd like to present, such as we're going to discuss 1031 exchange in and out, depreciation limits for 2023. We're going to do a small business tax update, talk about some tax loss harvesting. We're going to discuss some LLC situations, some updates on IRAs that just came out, specifically how trusts and estates are taxed, discussing the 706, and then some planning opportunities. So now, without further ado, Melanie is going to speak on those topics.
All right, thank you, Lori. There is just a little disclaimer on our presentation. It just kind of talks about you can't hold this completely liable for everything we say. No, just kidding. But there are changes that always happen after we do these presentations also. But so I am going to get started, and we're going to talk about 1031s and depreciation. Both of these topics can go into a lot of discussion and in-depth conversations. We are going to try to keep this with just some basic information, but then if there's additional questions, we can certainly answer those at the end in regards to both of those. But otherwise, let's start with the 1031 exchange. What is a 1031 exchange? It is also referred to as a like-kind exchange. It is used when someone wants to sell an asset and acquire a similar one while avoiding the capital gains tax. However, taxes under a like-kind exchange are only deferred, they're not eliminated. So you can't avoid these taxes forever. We're just deferring them to a later year. So taxpayers essentially can sell appreciated property, then end up acquiring new or similar property and defer paying any capital gains in that current year. Who can do a like-kind exchange? The quick answer is typically any tax-paying entity, but there are some exceptions to that. Any individual can exchange general and limited partnerships, C and S corporations, trusts, and like I said, any other tax-paying entity. Typically, most partnerships and S corporations don't pay tax, so that's why we can't always just say all tax-paying entities, but it does encompass most entities as far as the exchange. What type of assets qualify for a 1031 exchange? It must be real property. Real property is also known as any real estate property, which mainly includes land and buildings. This property must be owned and held for investment purposes, or it can be held for trade and business purposes as well. Personal property, such as your personal residence, does not qualify for the exchange. And any non-real property assets, such as equipment, vehicles, and inventory, do not qualify as well. So I've run through I'll run through just a couple scenarios that actually qualify for the 1031 exchange rules. First one you might not think of is if you own a shopping mall in South Dakota, it can actually be exchanged tax-free for swampland in Florida. To me, those don't sound quite similar, but they do qualify. We'll go into a little more detail later. Commercial rental property can be exchanged for residential rental property. Single family housing unit can be exchanged for a multifamily housing unit. So in the previous slide, I did mention they needed to be similar, but yet you can see here how they aren't exactly similar, but the tax purpose behind them is similar, which helps them qualify. So the commercial property exchange for residential property, most of that is rental properties, investment properties, if it's for business or trade purposes. So that's where the similarities come into, not exactly the similarity of the asset you're purchasing. So next, we will go on to scenarios that don't qualify for under the 1031 exchange rules. Most property that is held for personal use do not qualify. So these include your primary residence, your second home, and then generally we've seen this a lot is your vacation home. With some exceptions, this may qualify, but most situations we've seen is the vacation home does not qualify. So then also real property exchange for personal property do not qualify. And that properties held primarily, excuse me, for sale do not qualify. For example, you purchase a property with the intent for it to be flipped or sold. Those won't qualify. And then properties held in the United States cannot be exchanged for property in foreign countries. So it has to be properties held in the United States exchanged for properties in the United States. There are some time restrictions when it comes to 1031 exchange rules. The first one being the taxpayer has 45 days from the date that he or she sells the relinquished property to identify the new replacement property. This identification must be in writing, signed by the taxpayer, and delivered either to the seller or the qualified intermediary. The taxpayer must describe the property, including its exact address or an unambiguous description. The replacement property must be received and the exchange complete no later than 180 days after the sale of the exchange or the due date of the income tax return for which the year in which the relinquished property was sold, whichever is earlier. There seems that sometimes that gets very wordy and very complicated. So I kind of have an example. When we with the replacement property, it has to be, like I said, it has to be identified within the same 45-day limit, and then you have to the 1031 exchange has to be complete within 180 days. So, for example, you close on the property sold on June 1st of 2022. And then the new closing date, say, is November 30th of 2022. If you're looking at the exact calendar dates, that's actually 182 days. It's not 180 days. So you just now have a failed 1031 exchange, which then the gain on that sale now becomes taxable and the 1031 fails. So you want to be very careful when you're looking at those time restrictions and those dates and the sales to make sure you can qualify within those timelines. It is also helpful to have, I talked about a qualified intermediary helping with this, because you, as we'll see in the next slides, you have to follow these strict timelines, but you also have to follow other guidelines, such as you're not able to touch the money. It has to be put into a separate account that the intermediary actually holds for you. So we'll discuss that coming up. So here's a few more discussions on the time restrictions. Is that if both of the time restrictions are not met, the entire gain will be taxable in the year of the sale. And that since the transaction does not qualify for the like-kind exchange deferral, these time limits cannot be extended for any circumstances with the exception of a presidentially declared disaster. And if the seller takes control of the cash before the exchange is complete, in most instances, this will disqualify the entire transaction, resulting in the entire gain becoming immediately taxable. And then what happens if not all 1031 exchange funds are used? The portion of the funds not used will be taxable in the year of the sale. I've seen a few instances where they have a large gain, especially with some taxpayers coming from California. They'll sell a California property, exchange it for a property in South Dakota. That gain is large. The gain on the property in California is significant, that they don't end up using that entire gain when they purchase the property here. And so those funds, a portion of the funds that are kept become taxable. It's quite a calculation, but it does, you're able to defer some of the gains, but yet some of the gains are taxable in that year. So some may ask, why are 1031 exchange transactions a big deal? Most say yes, they are. It's as of 2019, it was reported that an estimated $65 billion of real estate equity was invested in 1031 transactions. That number is definitely more as of today. And then why is it? And it is truly one of the true tax loopholes that are available to taxpayers. There's not many of those in the IRS tax code. So when there is one, most like to take advantage of it if you can. So just some recent changes that have happened with 1031s. At the end of 2017, Congress passed and President Trump did sign into law the Tax Cut and Jobs Act, which became effective in 2018. Prior to that act, 1031 exchange provisions applied to both personal and real property. However, starting in 2018, as a result of the TCJA Act, the provisions only apply to real property now. It no longer applies to personal property. So just land and business, and like I said, the rental, trader business exclusions are what applies. So now we will move on to some recent changes in depreciation. Since September of 2017, we have had 100% bonus depreciation for certain assets placed in service. This means that you are fully able to deduct those assets in the year they were placed in service. So a lot of clients we've seen have used this to great benefits, actually, because we've just been writing off 100% of that asset. And it's been assets that qualify if their asset life is 20 years or less. So that encompasses quite a bit of assets. So starting in January of 23, so for tax year 22, we don't have many changes as far as that goes, but for planning purposes of 23 and future years, it starts to phase out. So for 2023, we moved down to 80% bonus depreciation for those eligible purchases placed in service prior to the end of 23. And then it moves down to 60% for those purchases put in service before the end of 24, 40% for the end of 25, and then 20% for the end of 26. So this has definitely played into some tax planning scenarios that we've had for future years. This is what we know these phase out limits to be as of now, but like we've all experienced, those can change and they can drastically change kind of at the last minute. But we have used these, like I said, for planning purposes when we're doing year-end scenarios for certain clients, especially looking into the future years. So. And then for 179 depreciation deduction, with bonus depreciation being 100% the last few years, we haven't had many issues with maybe 179 coming into play as often, because we've just been able to write off the assets using bonus. But now with that changing in the future years, 179 will come back into play and be very helpful for a lot of taxpayers. Under the current code section 179B2, there is the $1,160,000 limitation that gets reduced by the amount that the section 179 property placed in service during the 2023 tax year exceeds $2.89 million. So what that means is, aside from the bonus depreciation rules, you can use the section 179 depreciation deduction up to 1.16 million. However, if your total assets that were placed in service exceed the 2.89 million, the 1.16 million starts getting reduced. So those can be significant dollar limits. However, we do run into clients that they start exceeding that limit and then are limited with their 179 deduction. So also a major difference between the bonus depreciation and section 179 is that bonus is allowable even if it creates a net operating loss. And section 179 has its limitations where the net losses are limited. Bonus is also, like I said, for assets 20-year asset life, 20 years or smaller. And bonus is also kind of not necessarily a use it or lose it, but it applies to all of the asset life types. So if you have a 7-year property and you elect bonus on 7 years, you have to use all of the assets that are 7-year property. So it's, even if you don't need all of it, you have to take it based on the asset life, not necessarily the dollar amounts. So we will move into now talking a little bit about small business tax issues, some tax loss harvesting. We'll discuss some series LLCs versus just regular LLCs, and just touch base on some IRAs and IRA limits. Some of the recent issues that we've been seeing lately in the tax world involve topics relating to small businesses. About every business owner that I know and that we've talked to lately say that they're having troubles hiring employees, making sure they're taking care of their current employees to retain them, all of the above. It just seems that wages are getting to be extremely competitive around this area. And it doesn't really seem to be that there's an end in sight. And we've been talking to clients about just different ways to hire employees, different ways to retain the good ones. Wages, benefits, flexible work arrangements, the schedules, working from home. Obviously with COVID, it sent a lot of us home, and now we're just trying to juggle, how do we get people back in the office? How do you keep people? How do you get people that want to work, even just come to the office? But we also see that mental health has become a huge priority since 2020. So we're seeing a lot of employers that are focused on employees' mental health, and that they're no longer afraid to talk about it. It just seems that it's become very evident since 2020 that that's been a focus. The next is about ERC scams. The employee retention credit came out in March of 2020. Our firm has been working with clients to help calculate and claim those refundable credits against their payroll taxes for wages that were paid to workers during the height of COVID season. So this employee retention credit allows employers to receive a credit if they qualify on their tax returns, and it's pretty much dollar for dollar on wages that qualify. However, there are very specific rules as to how it qualify and which wages qualify. It looks at a reduction of gross receipts by quarter, and it's compared to those gross receipts of 2019. If you met that first qualification of gross receipts, then you did receive anywhere from a 50 to 75% credit on the wages that were paid during those periods. If you qualified and received the credit, it does require you to amend your business and personal income tax returns. And so it became very evident as the rules were issued, but the rules then got amended and changed and clarification, and it was kind of a big loophole for scammers to easily prey on businesses. And so the IRS has warned that there has been many ERC scams, and most scammers have been telling the clients that they qualify for these credits when in fact they do not. Like I said, it's a very complicated credit. It has various rules for the specific time periods it applies to. So if you think you might qualify, or even if a scammer has reached out that says you qualify, certainly reach out to your CPA or reach out to us, and we can definitely take a look at things and see if we can help. Then last one on this topic is going to touch base on employees versus independent contractors. We see a lot of questions from businesses where, how do you know if it's an employee that I need to pay payroll or if it's an independent contractor? And there's three main categories to consider when determining what type of worker you employ. And it has to do with either behavioral control, financial control, and then the relationship between the two parties. And as far as behavioral control, one of the questions we typically ask is, does your company control or have the right to control what the worker does and how they do their job? Are you telling them when to show up, where to show up, what hours they have to work? And so then it flows into the financial control, like how is the worker being paid? Are they paid on the job? Are they paid on an hourly rate? Does that person provide their own tools or supplies? Do they provide an invoice, or do they punch a time card? So depending on what those answers are, will help determine if it's an employee versus independent contractors. One of the big ones I always go to is, do they have their own sales tax license? And do they provide these services to other business owners? If that's a yes, then great, then you're clearly an independent contractor. You don't have to put them on payroll. But a lot of times employee or business owners want to get away from paying employees so they don't have the extra taxes, and it's just it's a big ordeal when you have to reclassify independent contractors to employees. So and if you've hired somebody that is likely in an independent trade or business profession, like I said, they're also probably offering these services to other businesses. And then if you always just want to remember that if you are hiring them as independent contractors, you want to make sure and check to see at the end of the year if you need to send them a 1099. 1099s are usually for services that you've paid to someone for more than $600 in that year. So not only you can get out of paying payroll taxes, but it doesn't always get you out of filing the forms. So, and then just a little more note on misclassifying workers is that if you have to reclassify independent contractors as employees, the IRS can hold you liable for employment taxes that should have been withheld for that worker. And then this can become a costly piece, as they will also charge interest and penalties for late filing those payroll taxes. If I have said anything to my clients regarding payroll taxes, is it's one of the steepest penalties the IRS assesses. They can assess up to 50% of the payroll tax owed. And so just a little mistake in misclassifying an employee can cost you a lot of extra money that maybe wasn't necessary. So next, we'll move on to just briefly talking about the capital tax loss harvesting tool that's available for clients. This relates to investments, stock market trades, all those investments. And last year the markets were up, doing great. Everyone was seeing some great returns on their investments. This last 2022, it was like we were kind of riding a roller coaster. It seems like we just kind of have felt that it hasn't been as good as it had been in the previous years. In this case, though, I've seen many financial advisors using what we call a tax loss harvesting strategy to benefit from the market volatility. What they do is when the market is down, you strategically and proactively harvest the client's tax loss, which then can be used to offset any other gains or reduce the current year taxes that they might have. You'll still want to remember, though, that net capital loss rules still exist and that you can only deduct up to $3,000 against your ordinary income. If you do have capital gains during the year, these losses can be used to offset those gains. For example, if you have $10,000 of capital gains in your portfolio, you can use this strategy to create some capital losses to offset those $10,000 gains. Say you had $15,000 in capital losses. You would use that to offset the $10,000 in gains. And then in addition, you would still be allowed to carry over or to use the $3,000 loss deduction on your return. Then you would use or have the $2,000 as unused losses that would be carried forward to use to offset future gains. So it can be beneficial, especially like I said, when we're having capital gains during the year, but yet there may be some opportunities where you have potential stocks or funds that have losses that you can offset some of those other gains. We just haven't had a lot of the ups and downs in the past few years, and except for this recent year that we've had. So that's what I've seen lately as far as that goes. It seems to be very beneficial and doesn't create, it helps limit some of the taxes that the clients have. So moving into the LLC discussion, we've had it's been some recent and new information as far as incorporating what we call series LLCs versus just a normal LLC. And so I'm just going to kind of go over a little bit of differences and then just some of the benefits that we've seen with the series LLCs. The series LLCs gives you all the same benefits of a regular LLC, but it serves as sort of an umbrella company with an additional flexibility and protection for multiple companies or lines of businesses within your overall operation. So you start with a parent LLC, and then you have one or more sub LLCs that branch off of it. However, all of the sub LLCs are typically isolated from each other. These can be used to help organizations protect their assets from liability, and in many cases can do so with less expense and more flexibility than the other structures that might mitigate liability risk, like a holding company or parent substructures. Series LLCs can be useful for LLCs that operate multiple lines of business or investments and want to isolate each line from risks incurred by the others. For an example, would include real estate investors with several rental properties would be separate from investment firms with multiple investment strategies. Without a series LLCs, these these businesses would have to form separate LLCs for each facet of their business to gain the same type of liability protection. Some things we have seen, though, is that not all states authorize the formation of the series LLCs, so you would need to check on the jurisdictions for each of those states, which I'm sure some of you that are listening today are aware of those. So, some of the main reasons for forming a series LLC comes into the cost savings, the flexibility of those LLCs, holding company opportunities, and the real estate liability protection. So depending on the structure of these LLCs, this will ultimately determine how it will affect you tax-wise. Whether some of these are sole members or multi-member LLCs will affect the type of tax returns you file. Currently, the series LLCs can file one federal tax return that encompasses the master LLC and all the series. However, the IRS has issued guidance suggesting that each series should be treated as a separate tax liability or tax entity, excuse me. But if that guidance that the IRS has suggested, that guidance is ever adopted, you would need to file a separate tax return for each of those series. So until we hear anything further, that's kind of how we're rolling with those. Moving into the IRA rules, this is specifically in regards to an inherited IRA. There's just been some recent changes since 20 and 21, but now they've kind of changed it again. But it's in regards to if you inherited an IRA either in 2020 or 2021, you were required to start taking your RMD distributions and distribute those within 10 years or possible sooner if possible. So what that means is, even if you weren't of age to have to take a required distribution, if you inherited that IRA, it came over with, you have to start taking it and it has to be distributed within 10 years or sooner. And if you didn't, there was a 50% penalty for not taking those distributions or taking the full withdrawal by the deadline. In most cases, we had a lot of clients that weren't even aware that they were required to take those, or they inherited it. They didn't think they had to do anything with it. So we were seeing a lot where they were getting penalized for not taking those RMDs. And so what we've just recently received is that the IRS is waiving those penalties until 2023. So any return that was filed in 2020, 21, or 22 that had inherited IRAs, there is no penalties if you did not take those. This rule does not apply to those that inherited the IRAs before 2020. And I know we have had clients that received those penalties. They filed the return, received that 50% penalty, and now the IRS is telling you you are able to request a refund of those penalties if you did file that and you weren't supposed to in those 3 years, or we weren't supposed to get the penalty in the 3 years. So lots of changes all over the place, and sometimes it's just a little change in the rule and it kind of throws our world for a loop some days. So this is just an updated PowerPoint slide for 2022 and 2023 retirement limits. We still do contributions for IRAs up until tax filing deadlines. So we always operate sometimes in a prior year, but then it's always nice looking forward to the next year when you're doing tax planning. But just some minor changes, more for inflation than anything, but the IRA limits for 22 and 23, and then it does list if you're over 50, you can do the additional contribution. The 401k limits went up $2,000 for 23 versus what they were last year. And then, as always with IRA plans, there are income limits that we need to be careful of when they are contributing. Sometimes if they make too much, they don't qualify for IRA contributions. And Roth contributions are always a great option. They're not deductible, but it does help taxpayers in the long run. But the Roth contributions also look at the income limits. So your AGI income limits for each year depend if you're eligible to contribute. However, I do have clients that their income might be too high to qualify for these options. And so we use what's called the backdoor Roth IRA. You end up you put in money into a traditional IRA account. You don't get the tax deduction, but then you can, within a certain time limit, you can convert that contribution to a Roth IRA. And then you have to report and pay the taxes on that conversion. But then once it's in that Roth IRA, you're able to let it grow tax-free for retirement purposes. So. All right. Yes, and now I will throw it over to Lori so she can discuss the trust and estate tax update.
Thanks, Melanie. I appreciate the introduction. I now get to speak about my favorite topic, the two things that are always guaranteed in life, death and taxes. So without further ado, we'll get into it. I've been working in the trust and estate arena for about 15 years now, and that's my specialty in the firm. So I just wanted to go over today some terminology for those of you who don't practice trust and estate law. I think everybody can benefit for this because we either know somebody who has passed away or eventually we're all going to pass away. So this is a good update on how we can plan for the future. So there's just some terminology that we need to discuss before I even get into the presentation. The first one is the Form 706. That's the big estate tax return. I think a lot of taxpayers get confused because when we say estate tax return, I never really know which one they're talking about. Most taxpayers are talking about the next one, which is the Form 1041. But I always want to clarify that there are two different forms that have to do with estate tax returns. So the Form 1041, if the estate makes over $600 after their date of death, then you have to file a tax return. The step up in basis is the biggest thing that has come out in the last 20 years. What that does is it steps up the basis of assets to the fair market value on the date of death. And that's every asset that a taxpayer owns. Then we're going to talk about a revocable trust. So revocable trust means obviously you can revoke it during your lifetime. So it's changeable, and usually there's hardly any caveats with that. An irrevocable trust, if it's funded during lifetime, gets no step up in basis. It also has the same filing requirement. If you make over $600 of income in a year, you have to file a tax return for that. But it truly is, you give up your rights to the assets the minute that you put it into an irrevocable trust. The DSU has to do with the Form 706. That stands for the Deceased Spousal Unused Exemption. And then portability is elected by filing Form 706. And we'll talk about that a little bit more in the next few slides. So let's talk about how they're taxed. If you have a revocable trust, which also is a living trust, a grantor trust, those are taxed usually every time, not usually, every time on your individual tax returns. We do have some clients that work with trust companies that enjoy the additional layer of protection by filing a tax return. Usually, most people prefer to just report all of the income in their Social Security numbers and then put that information on their individual tax returns. An irrevocable trust is done on Form 1041. And again, if you have at least $600 of income in the year after it becomes irrevocable, then we have to file the Form 1041. And then estate tax returns are also filed on the Form 1041, and they are also with the $600 limit after the taxpayer passes away. If you have an irrevocable trust or estate, distributions become the biggest item. The reason is, in trusts and estates, the income tax brackets are so condensed that, as you can see on the slide, at $14,450 of income, the taxpayers or the estate is in the highest tax bracket. The only way to get those things, to make sure that the estate or the irrevocable trust does not have to pay tax, is to pass those gains out and do distributions. So what that looks like, and we work together with lawyers in order for estates to be able to make sure that we kind of have an idea at the end of the year or the end of the filing year, what their income and expenses look like. We net those out, and then we have the trust or estate pay a distribution to the beneficiaries. What that does then is the Form 1041 will issue a Form K1, which shows the net income and expense that passes out. And then the beneficiaries use the K1 to report on their individual tax return and pay tax at that level. The great thing about that is if even one beneficiary is in a lower tax bracket than the maximum tax bracket, we've really, the taxpayer has done their fiduciary duty, because you're saving tax that would ultimately have cost everyone that 37%. If you have an estate that goes on a 1041, the year-end selection becomes really important. Estates can have fiscal year ends, or they can have calendar year ends. And we really get to choose which one they decide to do. But there's some reasons behind why we would select a fiscal year end versus a calendar year end. So one of the big questions we ask is, does the decedent have investments? If they have investments, a lot of times the option we'll choose is to have a calendar year end, because then we can go through and match the 1099s to the tax return. We have a lot of brokerage firms that I will say don't do a great job because they don't really know how to cut off the statements and get those into the estate EIN. The other thing I really watch for when we get 1099s is to make sure that after the date of death of the decedent, that all of those assets look like they've gotten a step up in basis, because we're doing a disservice to the client if we're not checking that. I've had several discussions in the last few months with the brokerage firms on how we could work together and make that an easier transition. So really, the biggest thing is working with our clients on the front end to try to save tax on the back end. Also, do income and expenses match? So let's say we have a farmer that sells some hay in the later part of the year, but the expenses that they have to plant crop for the next year don't happen until the beginning of the following year. In that case, we may choose a fiscal year end so that we can try to match those expenses to offset the income. And another note, in a final year of an estate, all of the income and expenses pass out to the beneficiary, because in the IRS's eyes, on the date that the estate year end is, that estate no longer exists. So somebody has to be responsible for that, reporting that income and expense. Let's move to the Form 706 and really how it works. You have to file if you want to elect portability or if you owe estate taxes. Portability, then the next bullet point is if you're wanting to carry over the DSU to the remaining spouse. What that means is, for example, if you pass away and your spouse is still living, then you would elect portability if you wanted to pass your unused DSU over to your spouse. So let's just say that your estate assets are worth $5 million, but as of last year, the estate tax exemption was $12.06 million. So what that means is if we do a 706, and elect portability, then the 5 million of assets would go against your estate, but the 7.06 million that remains would then port over to your spouse. And so when your spouse dies, then they can use the 12.06 million plus the 7.06 million that you gave them when they pass away. The major issue with filing a 706 is really, does the benefit outweigh the cost? The big cost with doing a 706 is not only the tax preparation, but what people don't understand is we have to justify every number that goes on that tax return. So if you have a cash account, I have to attach a bank statement. If you have land, I have to attach an appraisal. If you have business ownership, I have to attach a valuation report, of which I'm sure all of you know, valuations and appraisals are not cheap if you can even find anyone to do them. That seems to be the major issue. The other big issue that happens is people who are still alive, so the second spouse that's still alive, don't understand a lot of times what they benefit from doing it. And the answer is they don't. It's the beneficiaries of the second spouse to die's estate that really benefit from that. The great news is, and this was an absolutely huge revenue procedure that the IRS passed down in July of 22. Before they passed it down, what was going to happen is so let's back up. About 10 years ago, you could file a 706 and you had 9 months from the date of death in order to get the 706 done. Or you could extend that return an additional 6 months. So you basically had a total of 15 months to get the return done. With the Tax Cut and Jobs Act, they decided to switch that so that you had exactly 2 years from the date of death of the decedent, if you were electing portability. Now, if you owe with the tax return, then you don't get that additional time frame. You have to do the 15 months total. And if you think you're going to owe taxes, you have to pay with the extension in that 9-month period. The revenue procedure that came down in July says, if you're solely filing for portability and you don't owe tax, you have 5 years from the date of death to file. That is absolutely huge right now, because in the later slides, we're going to talk about what the threat is against the estate tax. And it comes down to a date where all of the provisions are set to sunset. Right now, the estate exemption is around 12.9 million. We'll get to an exact slide here in a few minutes. But what the IRS code says is, as of January 1st, 2026, that provision is going to sunset back to $5 million plus inflation. So we're talking roughly $6.5 million from what used to be about a $13 million exemption. So the next slide. So last year, the estate exemption was 12.06 million. And in 2023, it's going to be 12.92 million. So this is the slide that I was alluding to. The lifetime exemption is set to sunset, go back to 5 million plus inflation on January 1st of 2026. So the big question is, can we do a gift today to save tax tomorrow? This is a great issue that we deal with all the time. A few years ago, the IRS was looking at sunsetting that provision, or they were looking at decoupling the gift tax and the exemption. Right now, the gift tax exemption is the exact same as the estate exemption. So it's that 12.92 million. So in essence, you could give away $12.92 million and your beneficiaries would pay 0% tax on that. The big issue is, what happens if you have $1 over 12.92 million? The current tax rate is 40%. So 40% of every dollar is going to go to the IRS after that limit. The big issue with gifting, you don't get a step up in basis. You get the basis of whatever the person's basis was that gifted it to you. So we do a lot of tax returns for ranchers in South Dakota who don't want their land to be taxed when they pass away. So that they think about, okay, well, I'm just going to gift the value of my land to my kids. That's great and all, except when the kids decide that they don't want to ranch anymore, now they're going to pay buku bucks in capital gains because the basis didn't get stepped up with the gift because they did the gift instead of dying with it. Is it better to give it away or die with it? That's a heated debate right now, because what happens if you don't give your 12 million away and the provision sunsets in January of 26? And now your estate, you have $20 million in your estate when you could have gifted $12 million before you died, and it doesn't count against you. The IRS came out with a provision last year that said they cannot claw back a gift if you gift over the limit, whatever that's going to be on January 1st of 2026. So there's huge decisions that need to be made in the next few years, which is also why I think the IRS gave us 5 years, because right now my client may not want to do a Form 706, but maybe in 3 years, when we find out what that provision, what the estate exemption is going to go to, they can look back and say, oh, shoot, I really should have done a gift, an estate tax return. And now we can go back and actually file that. I think that's about all we have to present today. I don't know if anybody has any questions. I don't see anything in the chat. But I will put up our email addresses and our phone number in case you do think of any questions. We're more than happy to answer questions if you have any. Otherwise, we thank you for the opportunity of being able to present today.
Lori, this is Elliot. I actually do got a question, if you can hear me.
Yes.
On the federal exemption amount, there was some talk a little bit about the use it or lose it. Has anything come out on that regarding the tracking? If I make a gift of let's say $6 million over what it's going to sunset to, are they tracking that to say, hey, that's going to be applied to the 6 million above the 6 million that's going to sunset to? Have you heard anything on that?
We haven't heard anything yet. I'm really hoping that, well, we know they can't claw back the gift, so that's great. But we don't know if when you get to, if they decide to go back to 6 million, if they say, now you get an additional 6 million, or if that gift actually applies against it. We don't know. And frankly, I'm a little scared as to what that reconciliation is going to look like, because it's going to be me that has to do it.
Yeah. That's the worry with our clients. We can say, okay, you have 12 million or $13 million of exemption now. Why don't you gift 6 million now while you have the exemption? But if that's not tracked or reconciled, that could be applied to the 6 million sunset.
Right.
Okay.
You're exactly correct.
Okay.
Yep, you're exactly correct.
And then I have one other question. This is probably for Melanie. On the 1031 exchanges, have you guys been aware of the Delaware Property Trust where people are selling and then putting it into trust? Do those like kind exchanges work pretty smoothly, if you've heard of them?
We have heard of them. I haven't done any of them, but I don't see, as long as, I mean, they can go fairly smoothly as long as everyone is the participants all work and the timeline is fine. I haven't heard that there's been issues with using the Delaware Trust side.
Okay.
But not saying they're not coming in.
And then we got a question from Michael. Do you include appraisals on the 706, even if it's just being filed for portability? Isn't it sufficient to estimate the values and not attach appraisals? This is kind of a heated debate as well in the 706 arena. The problem is if the IRS ever audits your tax return, they don't really care what Lori Larson thinks the value is. They really want, if you don't want to get an appraisal, you at least have to have a CMA or a broker's opinion in order to justify it, because I have to have something to attach to the tax return so that they can see that it's not just me coming up with a value. Okay, I don't see any more questions in the queue.
Thank you so much, Lori and Melanie, for presenting today. If there are any additional questions, kind of speak up right now and we'll try to get those answered. But if there are none, and you think of some later, you can always contact the State Bar at info@sdbar.net and we can get them to the presenters, or you can email Lori and Melanie directly with their emails that are shown on the screen. Not hearing any other questions. Once you leave today's webinar, you'll receive a survey on the presentation, and we'd really appreciate it if you complete that and provide your feedback. And otherwise, thank you so much on behalf of the State Bar of South Dakota to Lori and Melanie, and thank you so much for joining us, everyone. Have a great rest of your day.